All right, today we're going to crack open one of the most powerful tools in all of finance, relative valuation. It's how the pros figure out what a company is really worth, not by looking at it in a vacuum, but by sizing it up against its competition. Let's dive in.
This is the big question, isn't it? Whether you're an investor trying to find the next big thing, a founder selling your company, or a manager trying to grow it, answering this is absolutely critical. And it's not just some academic exercise. We're talking about a high-stakes problem that drives billion-dollar decisions every single day.
So, here's our game plan. We're going to start by framing valuation as a kind of puzzle we need to solve. Then, we'll open up the toolkit and look at the actual methods. After that, we'll get into decoding the numbers and tackle the big real-world challenges. We'll even look at the tricky business of valuing private companies before we zoom out for the big picture. To solve a question as complex as valuation, you need a process. You can't just wing it. So we're actually going to borrow a framework from the world of management consulting to give us a clear path forward.
This six-step process is basically our roadmap. First, you define the problem. What exactly are we trying to value and why? Then you structure your analysis, picking the right tools for the job. From there, it's about gathering the data, digging into it for real insights, and finally, communicating what you found. Each step really builds on the one before it, making sure our final number is solid.
Okay, let's open up that toolkit. This is where the rubber meets the road, where we get our hands dirty with the core idea of relative valuation, which is all about comparing companies to their peers to figure out what they're worth. At its heart, relative valuation is actually pretty simple. Seriously, think about buying a house. How do you know if the asking price is fair? Well, you look at what similar houses on the same street sold for recently, right? We're doing the exact same thing, just with businesses.
But, you can't just compare a billion-dollar company to a $100 billion company directly. It's like comparing a mansion to a bungalow. So the trick is to standardize everything using what we call multiples. These little ratios are the great equalizer, letting us make a fair side-by-side comparison no matter how big or small the companies are.
Now, this brings us to a really crucial point. Are we trying to value the equity, the part of the business that belongs to shareholders, or are we valuing the entire enterprise, the whole shebang, including the value of its debt? If you're looking at equity value, you need to compare it to a profit measure that belongs to shareholders, like net income. But if you're looking at the whole enterprise value, you have to use a profit measure for the whole company, like EBITDA. The key here is consistency. You've got to compare apples to apples. So now that we have the framework, let's actually decode these multiples, because as you're about to see, they're way more than just numbers on a page.
Let's start with the most famous one of all, the price-to-earnings ratio, or PE ratio. It basically tells you how many dollars investors are willing to shell out today for every single dollar of a company's profit. It's the classic go-to benchmark.
But here's where you got to be really careful. You might hear someone say, oh, the average PE for this industry is 20, and that sounds super simple and useful, but that word, average, can be incredibly deceptive. Just take a look at this. This chart shows PE ratios for a bunch of US companies, and it's not a nice, neat bell curve, right? It's heavily skewed. You've got this long tail of companies with insane PE ratios. So if you just take a simple average, those few outliers are going to yank that number way, way up, giving you a totally warped idea of what's normal.
And this slide just drives the point home perfectly. Look at the numbers for the US market. The mean, the average, is a whopping 46, but the medium, the actual middle-of-the-pack number, is just under 16. That's a massive difference. If you use that average, you'd be completely off base. The median gives you a much truer sense of a typical company.
So all of this leads to a much deeper question. If we can't just trust a simple average, what's really going on under the hood? What fundamentals are actually driving a company's multiple? What makes one company worth 30 times its earnings and another only worth 10? Well, it really boils down to these three things: growth, risk, and cash. A company gets a higher multiple if investors expect higher growth, if they see it as a lower risk bet, and if it's more efficient, meaning it needs less cash reinvested to keep that growth engine running. So a high PE isn't automatically good, and a low PE isn't automatically bad. It all depends on the story these fundamentals are telling you. Okay, so we've got our tools, we understand what drives them, but now we hit what is probably the biggest real-world roadblock in all of relative valuation, actually finding companies that are truly comparable.
This quote from valuation guru Aswath Damodaran just says it all, doesn't it? No two companies are the same. They've all got different growth stories, different risk levels, different ways of doing things. So this whole idea of finding a perfect match, well, it's a myth.
And that leaves every analyst with this really critical trade-off. Let's say you're valuing a small local craft brewery. Do you compare it to just the 3 other craft breweries in your city? I mean, that's a super precise comparison, but it's a tiny sample. Or do you compare it to all publicly traded beverage companies, including monsters like Coca-Cola? You get way more data, but you also get a ton of noise from companies that aren't really all that similar. It's a tough call, and there's no easy answer.
All right, let's take everything we've talked about and apply it to the final boss of valuation, the private company. This is where the science really meets the art.
Think about it. With a public company, you're swimming in information. You've got a stock price that updates every second, super detailed financial reports, and you can sell your shares anytime. Private companies? They have none of that. There's no market price to start with, the data can be really thin, and you can't just cash out easily.
So these are the big hurdles. You don't have a stock price, so you can't use standard risk measures. And this last one is so important. The buyer and seller often have their entire life savings tied up in this one business. That means they care about the total risk of the company, not just how it moves with the stock market. And that completely changes how you think about its value.
We've covered a ton of ground, from the basic tools to the toughest challenges out there. So let's bring it all home with our final takeaway on what valuation is really all about.
I absolutely love this quote because it's the ultimate reality check. It is so tempting to find a stock with a really low PE ratio and think you found a hidden bargain. But, more often than not, the market isn't stupid. That company is cheap for a reason. It's probably because people expect low growth or they see some big risks ahead. A cheap price doesn't automatically mean it's good value.
And so I'll leave you with this final puzzle. Intrinsic valuation tries to find a company's true worth based on its future cash. Relative valuation tells you what it's worth right now compared to its peers. If you do both analyses and you get 2 different answers, which one do you trust? Well, the answer really depends on who you are. Are you a long-term investor looking for a hidden gem, or are you a deal maker trying to get the right price in today's market? And that is the final fascinating puzzle of valuation.